Let me bring on board Deepan Mehta as well, Director, Elixir Equities. Deepan, difficult to keep pharma out of the conversation this morning. I'm sure you've had a chance to maybe at least introspect a little bit. Give us a sense how you're looking at the latest announcement from President Trump.
Yeah, good morning, and thank you for having me on your show. Yeah, it's quite serious. If they follow through, that is, 2 years is a long time, and one doesn't really know how this will play out. But certainly, the sentiment in the stocks will get spoiled, and this will remain as a major kind of a Damocles sword on the entire pharma industry. But I think President Trump has been known to kind of roll back on many of the measures that he has taken in the past. This also will get challenged in the various courts of law, and the sustainability also will be tested. So, right now, all I can say is that the sentiment gets spoiled, the P multiples do get compressed because of it, and a fresh risk factor comes into play. Also, we need to keep in mind that what is the kind of a trade deal is done with US. We keep hearing it's in advanced stage, almost done, almost done, almost done. Every week, either side says it's almost done. But let us see the actual blueprint and implementation. So all I can say is that it is not positive for pharma companies. Actual impact on profitability may not be as much next to few quarters or so. But yes, I think certainly based on this news, investors will just wait and watch.
So should that be the case, Deepan? Would you say that do your homework and keep the list ready? Should they see an exaggerated fall, perhaps it could be a good buying opportunity?
No, no, no. You don't buy into such uncertainty. Uh, you know, you don't buy into such uncertainty. You wait for the uncertainty to settle down. And even if the stock prices have rallied after that, it doesn't matter. But at least you're in that phase where there's there's certainty and there's growth and there are reasonable valuation. That is the time when you press the buy button.
Okay, makes sense. A lot of other stocks which are going to be in focus. And Anant Raj, the board has now approved the demerger to separately list its real estate as well as the data center business. Anant Raj, of course, has been one of those data center stories much earlier discovered by the market as opposed to the rest of the supply chain. And Anant Raj, in the last 12 months, maybe 12 months may not be a fair comparison. The last 6 months at least has been quite the mover in the stock market performance. Kunal, a very quick chart check on what you see now for Anant Raj.
Well, I think the short-term charts were improving for Anant Raj because, on two fronts. One, the real estate pack had been doing very well. So from the March lows, I think Anant Raj recovered from 400 levels to almost 600. So a good 50% recovery, 30% recovery for the stock price from those kind of lows which we'd seen. The stock had come back towards a major reselective move. Remember, I think from 2020 period, Anant Raj was a stock which was at 65, 75s, moved up towards 950, 970. So more than a 12x, 15x kind of a return for the stock price. And post that, it went through a major correction from 2024 high. So I think now we are looking at a point where maybe the stock has settled into a trading range. We could be looking at 450, 600 broadly as a major trading range for Anant Raj. And I think dips should be bought into from a longer term perspective, specifically for individuals who have a slightly higher risk appetite.
The other ones, in terms of earnings, I want to quickly flag out Indian hotels as well. It's a decent set of numbers, frankly, but what really stood out for me was the occupancy number. 82% occupancy looks extremely strong. EBITDA margins and profitability on the higher end of what the estimates seem to suggest. So it looks like a very strong set in otherwise what was supposed to be a difficult Q1, given everything that played out in West Asia. Deepan, very resilient in terms of the business, trades at around, I believe, 50, 55 times earnings. A good time to have a relook at Indian hotel, just given the performance.
No, I think the numbers are exceptionally good in a rather challenging quarter. I mean, we just got the figures yesterday about the air traffic, which grew only 1.5%. And to have these kind of numbers is very impressive. I think shows excellent and very dynamic management, and very pleased with the numbers per se. Apart from what you mentioned, the data point which struck me was the 26% growth in management fees, because that's the way forward for Indian hotels. We would expect a higher proportion coming from managed hotels, because that would mean that the return ratios will improve and provide a bigger footprint to grow, because there's only so many new hotels that you can set up in locations which are attractive, where you buy the land or lease it and then construct the hotel. So management contracts is the way forward, and Indian Hotels has performed pretty well over there. So very, I mean, excellent set of numbers. I think 53 times a lot of guests just get priced in. So from these levels, I don't know, it may not give exceptionally outsized returns, but look, it's a steady performer, and it'll give returns in line with its earnings growth. And earnings growth we can expect to be in the high teens type of earnings growth. So from that point of view, I think one should remain invested. Fresh investment, I think just wait and watch at corrections. Maybe you could look at it.
Kunal, would those corrections come? 731 already on Indian Hotels, and it's likely to move up higher today, reacting to its numbers.
See, it's a very interesting stock because when the stock goes into any kind of a major breakout, you don't see any major corrective phase for Indian Hotels. It's a stock which goes into a very slow, subtle, gradual correction, gradual up move. But then the pace intensifies when you see the stocks moving up into higher bands of momentum. When the RSI crosses 60, 80 on the daily, weekly timeframes, that's where we see the momentum accelerate for Indian Hotel. But it hardly goes into a phase where the stock is suddenly very volatile. So, since the stock in the recent past also, when we look at it from the March lows, I think it done very well for itself. It was one of the few, hospitality stocks which had managed to come back above the 200 moving average much prior to the other peers like Chalet, Lemon Tree, etc. So that tells you that the leadership quality was still intact with Indian Hotels. I don't see any major correction, for the stock coming anytime sooner. I think that base of 700, 720, where the stock had been trading or taking support in the recent past, that should be a very solid base for the stock in the near term also.
Okay, that's that on Indian Hotels. Well, the big casualty today could be Bandhan Bank. Look out for what this stock does after the guidance cut that the management has issued. It's done about 1% ROA in the first quarter, but has cut the exit Q4 FY27 ROA guidance to now 1.2 to 1.4%. In fact, Mitali is here to give us more details on Bandhan's performance.
Right, for Bandhan Bank for quarter 1 FY27, the financials were a mixed bag, but the real disappointment, it came in from the management commentary and a sharp cut in their profitability guidance. But let's start with the positives first. Company's loan growth, it remained healthy at 16% and driven by continued strength in both their secured as well as the non-EEB portfolio, with their asset quality improving and also the credit cost declining to 1.8%. The bank also continued to strengthen its diversification strategy, with the non-EEB portfolio now contributing nearly 2/3 of its total advances. But there were several spots on the weaker side for this quarter. Deposits, they just grew by 7% yearly, significantly lagging the advances growth, even though the bank attributed this to a conscious reduction in their bulk deposits. Margins, they remained flat at 6.2%, failing to improve despite the changing in the loan mix as rising funding cost, that particular part offset the benefits. Operating expenses jumped nearly 19% yearly due to higher technology investments and a one-off gratuity provision, while the other income also declined because of the weaker treasury gains as well as the lower recovery income for this quarter, which the management has guided to improve in the quarter 2 and going onwards. The biggest negative, however, was the management's outlook for FY27. The bank maintained its FY27 loan growth guidance at around 14%, but slashed its profitability expectations. Earlier, management was targeting an exit ROA of nearly 1.6 to 1.8% by FY27. That has now been cut to 1.2 to 1.4%, and at the same time, the earlier expansion of NIM guidance that has been abandoned as of now, with management now saying that simply maintaining the current 6.2% itself would be a great achievement for Bandhan Bank. So overall, while the balance sheet, it continues to improve and the business transformation, it remains on track, the sharp guidance cut for ROA and that range bound, that particular NIMS guidance, that remains the near-term earnings outlook, a dampening effect, and quarter can be best described as operationally stable, but the weaker commentary, that will actually weigh heavy on the stock's reaction as we move forward.
Yes, Bandhan is something that could be a big casualty today, but Sagility as well posted a very weak quarter with the PAT rising about 46%, but it managed to miss the street estimates. The management is now eyeing the recurring seasonal revenue to return in Q3 and Q4. Dashita joins in with the highlights.
Right, Sagility is a healthcare outsourcing company that works mainly with the US health insurers, which contributes nearly 90% of its revenue. Now, coming to the results, the company reported a mixed quarter. Revenue was broadly in line to what the street was estimating, but the margins and profit came in below the expectations. Now, revenue rose 22.5% on a year-on-year basis, coming in at $208 million, while the rupee revenue growth was 27.6%. Now, coming to the profitability, but the EBITDA stood at 438 crores with the margins at 22.3%. Now both missed the estimates. The net profit increased 46% on a year-on-year basis, but that was too below the street expectations, finally reporting at 217 crores. Now on the operational front, the organic constant currency growth came in at 14.9%, and the company added 27 new clients, out of which 26 clients were added through CareSeed acquisition. And yes, now taking the total client base to 109. Now the management has maintained its FY27 guidance and expects a stronger second half, as Q3 and Q4 are seasonally stronger due to the US Medicare enrollment period, when the health insurers outsource the higher volume of work. Finally, looking at the brokerage, where Motilal Oswal has maintained its buy rating with a target price of 57 rupees and expects a healthy outsourcing demand, improving margins and AI-led productivity gains to support the growth going forward.
Dashita, thank you very much for that update on Sagility. But stay on with us. What's happening in Mastek, because it posted a steady quarter earnings with margins declining 60 bips on a sequential basis, and AI continues to drive growth momentum.
Announced its quarter one FY27 results and reported an overall in-line performance for the first quarter, with steady revenue growth and stable profitability and continued strength into the deal pipeline. Now, the revenue came in at 985 crore, which was up 5% sequentially, while the dollar revenue increased 0.6%, coming in at $105 million, which was broadly matching to the street estimates. And now the EBIT stood at 133 crore, while the margins declined 60 basis points sequentially, coming in at 13.5%. Which reflects slight pressure during the quarter. Now, the net profit was largely stable at 106 crores. But the biggest positive for the quarter was the improving business momentum. The constant currency growth accelerated to 1.8% as compared to 0.3% the previous quarter. And the 12-month order backlog jumped 25% on a year-on-year basis, coming in at 2,900 odd crores, providing healthy revenue visibility for the coming quarters. The AI remained a major growth engine. The company signed more than 40 new AI deals, with around 45% of the new order book coming in from the AI-led engagements. It also secured marquee wins from a leading healthcare group in Saudi Arabia and major retail wins in North America. Regionally, the UK and the Europe business continued to perform well, growing 6.5% sequentially. Mastek also maintained a strong cash and investment position of 945 crore. Within the service line now, the data, automation and the AI increased its revenue contribution to 13.4%, which highlights the company's continued shift towards the high-growth digital technologies. So yes, overall, to sum it up, despite some pressure on the margins, Mastek managed to deliver a stable quarter, which was supported by the improving demand, strong order backlog, sustained AI-driven deal momentum, which leaves the medium-term outlook constructive.
Dashita, for that. Deepan, what's your view on the IT companies? You still have the one of the big boys, Infosys, coming out with earnings tomorrow. So far, how do you assess the entire IT earnings?
Well, I think the industry still remains quite challenged, and there's no clarity how AI will play out for the software services industry. And on the whole, I think that nothing has materially changed. So I would remain cautious on the sector as a whole. There could be a few outliers, companies which benefit from the disruption or which are ahead of the curve. With usual disclosure, we and our clients are invested companies like Persistent System, Coforge, Happiest Mind. I think they have an edge as compared to larger software services companies. I think larger the company, the more challenges in place, because these contracts are typically short-term contracts with lesser contract value. And that doesn't make much of a difference to a large company, but a small mid-sized company, it can make a huge difference in terms of growth rates. And then I think there are certain SaaS companies we like Orion Pro, New Gen Technologies. I think they also have very good growth prospects according to us. But I think right now the street is painting all software service companies with the same brush. So I'd be a bit cautious, and even on good numbers, just wait and watch. Like I thought Mastek numbers were good. They showed a 26% rise in the total contract, the order book position, which is quite impressive. But yet I don't know whether I have the conviction to buy the stock because just the sentiment is getting spoiled in these companies.
In fact, we've got some of the other newsmakers as well in trade today. Sunteck Realty, strong Q1 print. The realty majors' profit and margins have both expanded because of the steady residential demand. Ravinder, in fact, is here to highlight the details.
Well, as Sunteck Realty has announced its Q1 FY27 earning, and overall it was a strong numbers on a year-on-year basis, but it was slightly below the street estimate. And if we talk about the financials of company, revenue grew by 1.7% on a yearly basis, and net profit has also increased to 26% on a yearly basis. And the key highlight for the quarter was margin expansion. EBITDA margin improved sharply to by 933 basis point year-on-year basis to 35% on a yearly basis, which are supported by the higher operating margin, better cost efficiency, operating leverage, and steady demand in the residential segment. And revenue growth was driven by healthy project execution and timely revenue recognition. And on the operational front, company continued to witness strong demand momentum. Pre-sales increased 20% on a yearly basis, and with FY27 pre-sales guidance of 3,945 crore, the company has already achieved 20% of its annual target in the first quarter of FY27, and the board has also approved an enabling resolution to raise up to 2,250 crore through multiple routes, including QIP, FPO, ADR, etc. And looking at the company from the Q4 con call, the management remain optimistic with the planned FY27 launches, which includes various launches across the Mumbai region, with a total estimated GDV of rupees 7,000 crore, and backed by the strong launch pipeline, the company is confident of delivering 25% pre-sales growth during FY27.
Ravinder, thank you very much for that update on Sunteck. Let's move on to the auto companies. We had two companies that came out with earnings yesterday, Bajaj and TVS. Bajaj expects supply disruptions to ease in the second quarter after the ransomware, LPG curbs, and West Asia tensions hit Q1 production by up to 15%. Meanwhile, brokerage like Motilal Oswal has upgraded the stock to buy, citing strong product pipeline and export momentum. Avi has the details.
Bajaj Auto Q1 FY27 results have come out and the numbers are very good. The street was expecting an EBITDA margin of 20.1% due to commodity cost pressures, but this company delivered 20.9% of EBITDA margin, which is very positive. The supply disruptions are expected to ease starting Q2, but things like labor shortage, electric components will continue seeing a shortage in the Q2 as well. The exports are targeted at 250k units per month, and the Chetak EV is seeing a very strong demand, much beyond what the supply can meet, and it has also turned EBITDA positive and is now scaling up from 50k units per month to 60k units, which will further help the company to expand its EV portfolio. The commodity inflation came in much higher from the earlier guidance of 3.5% to the actuals of 4.5%, and is expected to ease since starting Q2. They are also taking capacity expansion from 7 million units to 9 million units in the near term, with focus on premium bikes, EVs and three-wheelers. The Bajaj Auto Credit has also risen by 70% on a yearly basis and is doing an ROE of 25%. Big brokerages like Motilal Oswal has upgraded it to a buy and given it a target price of 12,100 rupees, which is a 16% upside. MK is giving it a target price of 13,700 rupees and Nuvama is giving it a target price of 12,000 rupees. Motilal Oswal is factoring in a projection of around 20% growth in revenue, 22% growth in EBITDA and PAT, saying that all the segments are doing well, with the export markets poised to lead the growth for Bajaj Auto.
In fact, we're going to be chatting with the Bajaj Auto management as well in the due course of the show. But on that note, we'll take a very quick break. When we come back, we'll continue our market discussion with Dipan Mehta and Kunal Bothra. Back with the market right here on ET Now. Yes, Bajaj Auto is going to be one stock in focus. We were just flagging off the earnings before stepping into the break. And of course, yesterday's star performer, TVS Motors, after its numbers, and the way it shot up about almost 6%. Dipan, analyze the entire two-wheeler space for us, and let's throw in EVs like Ather Energy as well over here.
Oh, I think very good set of numbers from Bajaj Auto and TVS Motors. So that's one thing which is quite positive. And I do feel that you may expect some slowdown overall. So it's not a sector that you now rush in to buy because a lot of things are discovered. The benefits of the GST cut also are steadily got priced in. So I would be a bit cautious. I mean, I remain invested, remain positive on the long-term prospects. But for these companies to sustain these kind of growth rates, I'm not so sure. Especially TVS Motors, I think phenomenal set of numbers coming through over there, and I would say richly valued as well compared to Bajaj Auto and Eicher Motors. So as I said, I think better to be neutral in the sector and enjoy this upcycle, this up move which we are seeing, because at some point of time, I think base effect will catch up for these companies. Also, I think cost increases also start to seep in, and at some point of time, I think this competition from electric vehicles that will also start to pinch because end of the day, the two-wheeler EVs, the margins are not as high as the traditional ICE motorcycles or scooters. So that's a kind of a threat for the industry as a whole. Unless two-wheeler EVs are at a mass scale, they will not be as profitable as the existing business.
Deep, Deepan, within the PSU banks, we've seen one PNB, doing giving out good numbers there. But how do you look at the entire PSU bank space? Going into the earning season, the market was tilted more in favor of the private sector banks, which has disappointed the market. Now, do you think that the churn which we are seeing in the last couple of days, movement from private to public sector bank, that would be a sustained one?
See, I think as an investor, first of all, in the banking sector, I would be a bit cautious. Across the board, the underlying trend has been high competition, unsustainability, or actually, we are seeing net interest margins under pressure. We are seeing CASA ratios under pressure. So, minute CASA comes under pressure, automatically the net interest margin comes under pressure because you don't have as much access to low cost deposits. And these are secular trends. I think it's not going to change even 3 years, 5 years from now. They're going to be struggling with CASA, they're going to be struggling with net interest margins. And right now, what is saving the industry is extremely low credit costs because we are in a cycle which I've never seen in my career where such positive NPAs, I would say such low NPAs we have never seen ever in the past. At least I haven't seen. And at some point of time, that will turn. I mean, because the lending book has grown over the last 2, 3 quarters, 2, 3 years or so. So at some point of time, the credit cost will start to inch up and move in line with the pre-provisioning operating profit. So I would be a bit cautious. And you're right. I think, now what we are seeing for the first time since private sector banks have come into operation, that PSU banks, a lot of them, their numbers, growth numbers, qualitative numbers, NPA numbers, return ratios, whichever parameter you compare a bank with, a lot of the PSU banks score higher than the private sector banks. So investors are wondering that what's the logic of buying something like an HDFC or ICICI, which is going at 16, 17 times when you can get a PSU bank at anywhere from 6 to 8 times or so. So first of all, the P multiple between the private and the PSU banks has narrowed. I expect that to narrow even further in the next few years or so. And eventually, I think there'll not be much of a distinction as we see between private and public banks. But I still reiterate that right now, I think 1, 2 quarters will be good because of the FCNR loan growth. But beyond that, I think it's a very challenging environment. It's a red ocean for the banking sector. So I would be a bit cautious.
A bit cautious right now on the banking sector. That's what Dipan's call is. Let's also welcome on board Rajesh Palvia. Rajesh, hi. Great to have you today on ET Now. Tell me, how is it that you're looking at the constituents of the Nifty Bank right now, given the stark underperformance from HDFC Bank, Axis up until day before, and then even SBI, which is under pressure as the entire street is now looking up to what SBI is going to deliver in terms of earnings?
Yeah, hi, good morning. It's a mixed kind of behavior in banking space. If you look at the overall structure for most of the large cap private bank, most of the banks are still struggling to give breakout of their short term resistance area. So I think we may see further more consolidation in large cap private sector bank, as well as if we look at the PSU banking basket after a corrective move, some recovery trade is taking place in some of the PSU bank, be it PNB, Canara Bank. Even SBI also recovered from the lower level. But yes, in the previous trading session, there was some profit booking in PSU banking basket also. But looking at the long-term structure, I think SBI is still, holding the strength on the long-term chart. So any decline towards 1020, is a buying opportunity in SBI until this stock is holding about 1000 level. I think those who are looking for a little positional perspective on investment side, so they can, buy and accumulate SBI as long-term structure is still intact. And any breakout above 1065 can take this stock further higher, and we may see new trajectory for SBI also. But on the private sector bank, I think some of the small bank like KTK Bank, Federal Bank, these banks are positioned quite strong across all time frame, and we believe that here we could see some more momentum on the higher side. So from private sector bank, I think these two banks are on our radar. But from the large cap universe, I think ICICI Bank, if you get a correction in this volatility around 1400, 1420 would be again, attractive level to buy ICICI Bank. So here also we are keeping this stock on our buying list in the decline.
Rajesh, another sector which would be in focus is the hotels and sector, especially after the Indian hotels number. How do you look at some of the stocks there? ITC Hotels, Indian Hotels, Lemon Tree.
Yeah. So if I analyze most of the hotel stocks, only Indian Hotel is looks quite stable. If I analyze on a technical structure, though there was corrective move in ITC Hotel, and now it's trading around its crucial support area of 20-day, 50-day moving average, which is at around 160 zone. Any breakdown below 160 can extend further more gain. So since last couple of days we are seeing sustained supply pressure in ITC Hotel, but again Indian Hotel is still looking confident and consolidating at higher band of this up move. Looking at the structure for Indian Hotel, we believe any breakout above 760 can take this stock further higher, and we may see higher trajectory towards 800 to 820 also. So Indian Hotel is looking promising from this universe, and I think any decline towards 700 is a buying opportunity with stop loss of 680.
What we'll do is, Rajesh, will come to you in just a minute, but bullish on Indian hotels. That's the point we're trying to make. Deepan, let me come to you with regard to some of the gold lenders. And we saw that very strong run up through calendar year 2025. Now we've seen a bit of a cool off. How should one look at the gold lenders? And of course, Manappuram is doing things on its own, but that's because of management change and the like. But give us a sense how you're looking at the gold lending pack.
Yeah, I think gold lending also is a well-discovered story, and it's one of the hottest segment within the banking industry. I expect competition to improve over there also. A lot of the banking commentary which we are seeing and NBFC commentary, they're all focusing on gold loans. That's been the best segment for them. So from that point of view, again, I think it is well discovered, well priced, if you ask me. Manappuram, yes, I think change of management certainly has improved the sentiment. Eventually, we should see higher growth rates. To an extent, Manappuram had gone into many of the non-gold products, and that has impacted the performance of the company. NPAs also had shot up. So there could be a re-rating in Manappuram, and I'm positive on that stock. But rest of the gold finances, I think it's pretty much well discovered. I think IIFL, from a valuation perspective, looks attractive as compared to some of the other gold financiers because it also has a very large exposure to gold. So I would say that it's a kind of well priced story, and I think if investors invest in these companies, I would remain invested. But there's no real edge over here in entering these stocks at these levels.
And Deepan, I wonder what you make of Bandhan specifically. I mean, there's some re-rating possibility there, just given the fact that ROAs were expected to inch up above the 1.5% number. But now cutting back on guidance, looking slightly more sanguine. How should an investor look at that?
Yeah, I think Bandhan Bank is amongst the kind of outcome of intense competition within the sector, which we spoke about earlier. And it's one of the companies affected by that particular competition. In any case, I think Bandhan Bank has disappointed investors many times, and it was when it got listed, it was like a nice pure play, well managed microfinance NBFC turned bank, and great aspirations, hopes were there that they would really grow faster than the industry. But instead of that, I think this bank has grown at a pace lower than the rest of the industry, and still valuations remain at a high level. So I would give it a pass at this point of time. And of course, I think the sentiment has got completely crushed because of this very weak guidance that I can see on your screen. So I think it's challenging time for shareholders of Bandhan Bank. And I mean, I really don't see any edge that Bandhan Bank has got or any differentiation which justifies remaining invested in Bandhan Bank.
And yeah, look at the stock price as well, already lower by about almost 10%, and these are just the pre-open rates. But Dipan, great to have you on the show. Thanks as always for your time. Okay, let's get back to what the market is up to right now. Just want to quickly check in on TVS Motors and Bajaj Auto too, while the Nifty is headed in for a quiet start, going by the pre-open rates. TVS Motors higher by 1.5%, and this, mind you, is in addition to that near 6% move yesterday. And Bajaj Auto higher by almost 2% as we speak right now. What's happening with Manappuram and Muthoot, given the high flyers that they turned out to be in trade yesterday? Today, the first rates haven't quite trickled in on these names. But yes, across the board, you are seeing some good moves on a Sagility, on an Indian Hotels, TVS, Bajaj Auto, ONGC as well, given that crude has jumped up over 1% overnight and we're already headed above the $92 per barrel mark. So look out for what these stocks do in today's trading session. And then, of course, Mastek, Anthem Bio, Bandhan Bank. You also have Gabriel India, MedPlus, Aavas Financiers, Hudson Agro. These are all negative earnings, or rather haven't quite matched up with what the street was anticipating. So do expect a negative reaction perhaps on most of these names. Just counting down to the market open, and Kunal, it's worth a revisit. The gold financiers, Manappuram, Muthoot, and I remember chatting with you about some of the gold retailers as well, the jewelry retailers, that is, Titan and the likes. What's looking good for a trade this morning?
Yeah, I think it's a very interesting space now building up, because you have seen likes of Manappuram Finance, Muthoot Finance recovering very, very smartly in the last few months, and specifically Manappuram Finance. There was this big divergence which was there between these gold financiers, where Muthoot Finance in 2025 and till Jan 2026 was one of the best performers from the pack. But then surprisingly, I think the stock in the last 4-5 months have gone through a 15 to 20% correction, and it's now recuperating from those major losses. But in that time span, now Manappuram Finance has now moved from those sub 300 levels to 350 plus, where it closed yesterday. So that's one stock which I believe should be on traders' radar, because of that consistent bout of outperformance and that comeback ability which Manappuram Finance is showing in terms of the charts. From the jewelry stocks as such, retailers, I would believe Kalyan Jewellers as well as Titan, both of them are attractive bets at the current levels. Now, the only catch with Kalyan Jewellers is because of this 25-30% plus run up the stock has already seen in the last 10 odd days. You might probably expect that the stock may go into a sudden patch of consolidation or a sudden price correction or a mean retracement. But that, I think, could be a good opportunity for traders who are looking at a medium-term time frame to add further. So I think both these stocks are looking attractive from the space.
I wonder, Rajesh, how are you looking at some of the AMC counters? Aditya Birla Sun Life was one of those casualties yesterday. Of course, earnings being the trigger, but give us a sense on charts. How is it looking?
So there is a clear breakdown on the near-term chart. Stock has broken the upsloping trend line support area on the weekly, daily time frame. And looking at the breakdown in Aditya Birla Sun Life AMC, I think if it's sustained below 1070 mark, I think we may see further more profit taking in this counter, and possible down move towards 1990 we may see in the near-term perspective. So at this moment, I think one should wait, as overall long-term structure is bullish, but on the near-term chart, some profit taking is taking place. So I think 1000 would be the level where one can revisit it. If it settled down around those level, it will be again, buying opportunity around those level.
Okay, just 57 seconds left to go before we kickstart the opening bell for this morning. Infosys numbers due tomorrow, so look out for what this stock may be doing. Yesterday, some of these names were under pressure, both the likes of a TCS and Infosys. Let's see what direction they actually take in trade today. Given that, many of these large caps and especially IT has a typical behavior of moving ahead of the earnings and then cooling off thereafter, even if the numbers do tend to come in line. Reliance, HDFC Bank and SBI, that trio really seems to be the trouble point for the index, and that was the case yesterday as well. While the breadth of the market did fare a lot better with individual pockets, some select banks, NBFCs and autos, of course, holding out very, very smartly in trade. Let's see what the texture turns out to be today.
Opening itself, and Nifty again revisited its important and crucial support area of 24,050, which is very important for intraday perspective also, and for this near-term trading setup per se also. So any breakdown below 24,050 may, encourage more profit booking in the market, and maybe we could see some put writers may cover up their position, as major put writing activity, which we have observed in last couple of days around 24,000, 24,100 strikes. So these levels are very important for near-term setup. Though there is some recovery is taking place from the lower level after this gap down opening. So I think one can focus on stock specific, as the broadly market is in a range only 24,050 and 24,200, 250 zone. So I think index may consolidate further more in this range only, but stocks from the automobile space, NBFCs are also, showing sign of buying interest, as well as FMCG basket is also looking attractive at this juncture. So I think one can focus on these three, four, sectors where, stock specific opportunities are there. But for index trade, I think we will wait for another couple of 10, 15 minute more to settle down this supply pressure. If it's hold 2450, one can, initiate buy with stop loss of 24,000.
Right. Okay, that's the call on the index. Kunal, any tempting trades?
So I'll go in for Sun Pharma. I think that could be an interesting bet, specifically with this 1.5% on the downtake. 1925.30 is where the stock is trading right now. It looks to be an attractive contra bet.
Okay, that's a contra bet. A buy on Sun Pharma coming in from Kunal.